Hi there, Serial Trader here. Just going to look at the major US indices, and we'll start with SPX here, and we'll kick it off with just some short-term Elliott wave analysis. So nothing's changed on these larger degree patterns as of yet, and it looks like we have our initial A wave down. We have a little 5 down for A. Looks like we're coming up for a B wave, which should fail to make a new high, and then we should have a C wave down if we're just going to do a simple 3-wave zigzag decline, and this will be potentially for this wave 4 as long as we can stay above this level, which would be the wave 1 of that degree, which I think is 27.91.47, I believe is the level. So anything above that in this pullback we can still confidently label as a 4th wave, and then we'll have a 5th wave up, and that'll complete this larger 3, for this 1 too. Then we can have another 4 as long as we stay above that level. It can be considered a 4, and I'm starting to get ahead of the action here, but just what to expect roughly going forward. Now, if we do have a 3-wave decline or some sort of decline and we exceed this, doesn't mean that this is all bad. It just means this particular labeling scheme has to be changed, but for now we'll go with it until it stops working. So going in closer, let's say the 15-minute time frame, definitely have a nice 5 down. I'm labeling that currently as A. I believe we're working this B wave retracement at the moment, and very likely this fails to make a new high, and then we'll have a C wave down. And we have this previous pullback level here. It wouldn't be uncommon to go and test that maybe, but ideally, if we want to continue the higher low pattern, we actually finish the pullback above this level, and then maybe have something like that. But I'll go with the Thinkorswim platform here in a moment, just to show a potential way to play this. All right, so here's SPX, and really we just had a nice reaction off that 20-day simple moving average, even if it's just a temporary bounce off of it. And we're slightly above the T line, although not showing any particular buy signal. And this gap that we have here, that is still very much in play and potentially acting as resistance at the moment. I don't imagine we'll fill this gap just yet. I expect another leg down and then maybe come up, fill the gap, and go after new highs, but we'll see. Now, that being said, this is SPX. We'll go to SPY, okay? Look at a potential trade setup. And we'll drop the time frame down a little bit here, 10-minute. Maybe hourly will do. Yeah, hourly should be fine. Okay. So let's say we have our 5 down, 3 up. I'm not saying it's done, it's retracement just yet, but let's just say we have something like this, and we're going to be working another leg down. So we'll look for some relationships. I'm not saying this is over yet, but just measuring from where it currently has retraced to. We'll look for the 618 and the equality relationship, which would be the most typical for just a simple ABC down. And okay, so on SPY, the 618 comes in at 281.55, and the 100% relationship currently, as it's being measured, I mean, this could increase a bit before we roll over, obviously, around 279.93. But just to give you a rough idea of some levels, some key levels, and then the previous pullback level obviously was 279.16. So let's call it around 280. 280-ish would be a good level to look for this decline to find support at. Now, knowing that, let's go to the option chain for SPY and look at a potential trade. And I think I have something in mind for this. So we want the options that expire very short term, because this is a short term pattern working. I would say we're going to be looking at the 17th of August expiration date, so this coming Friday here. And okay, so at the money is roughly around 284 currently. So I'd be for this kind of play, I'd be potentially looking to buy the 284s and sell the 280s. Okay, so a debit spread. So I would be doing a vertical spread. I'd be buying the 284s, selling the 280 strike. I'll just show an example with 10 contracts. And let's just analyze that. Okay. Risk profile. All right, here we go. And we'll include the commissions. Black-Scholes model. So this just gives a idea of how this would perform. So your maximum risk would be $814, okay, and that would be anything above 284. Essentially, you realize the maximum risk because that's above the strike price that you're long. Now, at expiration, so on Friday, anything below, by the looks of it, 283. We'll call it roughly 283. Anything below 283, you start to be profitable. And then your maximum profit is $3,185. And that's anything below the strike price that you sold. So that would be the 280 strike price, because obviously at that point the 280 sold puts lose value just as quickly as the 284s are gaining. So it just locks you into your maximum gain there. So, okay, if you think about this, your maximum risk, $814, maximum reward, $3,185. So that's a nice, theoretical risk-reward ratio. And then that's just purely, your mathematical at expiration numbers. And then if you actually look at the chart, the likelihood of this happening, okay, so we've had a nice 5 down. We're working our corrective bounce up, that B wave I was showing. And then, if we just estimate that the decline will consume a similar amount of time as the initial decline, so if that's the A wave, how much time the A wave consumed, say we end here, this is how much time the C wave might consume from the B. That would take us, well into next week. So that's to say that this should be declining towards and into Friday, which is the expiration date of these options. So that's a potential trade setup, a pretty attractive one. Just analytically, it looks attractive. And then as far as actual risk reward and the amount of capital you're risking to how much you're going to make and the likelihood of that all taking place, this is quite attractive. So it's nice when you do a debit spread. So obviously we're limiting how much potential reward we can make by selling these 280s, but we're also limiting the risk by essentially 25%, because we paid $1 or so, looking at the option chain, we paid $1 or so for the 284s, but we took in 25 cents for the 280s, so that immediately reduced the risk of just buying the 284s by 25%, and it still allowed it to run to the price that appears to be a likely area to go to. So really, yeah, theoretically you're limiting reward, but analytically this is all you're really expecting as far as the decline goes anyway. So it's an attractive setup. I mean, unlimited reward potential sounds nice, but that usually doesn't happen. Usually the the plunge protection team kicks in and we just start heading up again after a little pullback, and that's not going to change until we really start breaking major support levels on the SPX chart. We're just nowhere near doing that yet. Still looking higher overall in the trend, even though this is a nice little short-term bearish play, right? So hopefully that works for you, Denzel. Now, I'm not personally doing this trade, but I would do it. It's certainly attractive. I like it. But I'm just trading the ES futures and focusing my attention on that at the moment. And that's... I'll probably do a live video of a trade execution, trading the futures. but I have to concentrate very hard when I'm doing it. It's very fast paced. I'm typically working from a 2-minute price chart, so to narrate it properly, I might have to just record it, do the trade, not say a whole lot while I'm doing it. Say what I can, obviously, but need to concentrate on what I'm doing, and then close the trade, and then also just go over it right after, once everything's been complete, and just analyze it. That could be an interesting video, but I'll do that whenever. And okay, so now that we're done with this, we'll just go to the Dow Jones Industrial Average to do our regular little market analysis. So Dow Jones Industrial Average looks weaker, still below the T line, actually rejecting off the 20-day simple moving average. Oscillator is still not oversold, so that indicates we can go down further. I still like this 50-day simple moving average as a potential downside target, and again, that comes in around 25,000 on the Dow. All right, and then the NASDAQ composite. Let's have a look at that. Okay, NASDAQ composite, a little bit of strength today, got above the T line. NASDAQ still in overbought condition, just starting to roll down. So NASDAQ looking relatively stronger than the S&P or the Dow, but I would imagine it would still come down in some sort of minor pullback, maybe down to the 50-day simple moving average, like it did before, if the overall market comes down. But definitely still noting some relative strength in the NASDAQ. Now the Volatility Index, have a look at that. So VIX had a little bit of a breakout. We got above this resistance area here, which I believe the top of was 1453. We got as high as 1502 yesterday. Certainly no follow through though. Now today we closed 1331. So VIX still having trouble getting going here, which so far is just indicating to me that the pullback we're in the middle of is just going to be another minor one and set up for another up move once complete. But just very keenly watching. If we do get above some more significant resistance levels on VIX and start breaking more key support levels on the indices, then I'll start entertaining that, okay, might have a bigger move down, but currently not seeing that. All right. Oh, and I think I'll just mention one more thing, going back to the trade idea. So another attractive thing on SPY options, or if you're doing the index options, SPX options, what you'll notice is there's a volatility skew, okay? So the implied volatility increases a lot the further out of the money you go on the put options, okay? So you see the at the money options, the 284 strike, it's pretty low implied volatility, 7%, 7.69%. Now the 280s that you're selling have a 13% implied volatility, so almost double the implied volatility just for going 4 strikes out of the money here. And you see if you go down further and further, the implied volatility gets higher and higher, and that's because the options market is pricing in a premium for a, however unlikely, but the possibility of a large move down, that is reflected in this volatility skew, okay? Because they don't like selling out of the money puts cheaply, because once in a while you get a nasty move down and all of a sudden they sold puts and weren't compensated very well for selling them because of that. So they're always priced for a large yet unlikely move as far as implied volatility goes. And that's always been the case, I think, ever since the 1987 crash. That's created this volatility skew on the put option prices. You notice on the call option prices, you really don't see that same skew. I mean, if you go really far out of the money, you start to see some higher implied volatilities, but anything just, reasonably out of the money, if anything, you actually see a little bit lower implied volatility than the in the money or at the money options. So that's a notable advantage when you do a debit spread, like I've shown here. Is you're selling something that has a higher implied volatility than what you're buying. So that's attractive in that rate, and that's completely separate from just the actual analysis of the chart and the details of the direction of the trade and all that. That's just kind of a, if you want to call it implied volatility edge that you're getting. So, all right, that's probably good for now. Serial trader signing off.